Hello and welcome to Switzer Investing. I'm Peter Switzer and this is our first show in our new studio. That's been a long time coming thanks to the coronavirus. On tonight's program, it's quite a controversial one. I interviewed Chris Joye late last week and Chris was talking about the possibility of a 30 to 60% crash of the stock market. I of course did push him on when he thinks it might happen, and that's going to be something you'd like to hear in the interview. But I've asked my expert guest, Joye Liu from Birmingham Invest, to give her reaction to Chris's big call, as well as she looks at the stocks she likes with reporting season upon us. And then Jun Bei Liu of Tribeca Alpha Plus, she also had her opportunity to react to Chris's big call, and she likes 4 very interesting tech stocks at a time when tech stocks and payment stocks have been really beaten up. And then finally, we have Paul Rickard reacting to Chris as well. And Paul takes his sort of considered view. Chris and Paul both come from the bond market, but Paul later became a very well-known stockbroker as well. So he has a foot in both camps when he looks at the kind of big calls from a bond expert like Chris Joye. And of course, before Paul, there's the major interview with Chris Joye himself, which is, as always, quite entertaining and always insightful. But it doesn't mean that he's always going to be right. So that's the show for tonight. Let's kick off with Joye Liu of Birmingham Invest. Well, joining me now is Joye Liu of Birmingham Invest. Thanks for joining us, Joye. Now, Joye, before I start asking you about stocks, I interviewed Chris Joye late last week, and we'll show the interview later in the program. And Chris was talking about the likelihood of a 30 to 60%, I won't say correction, that's a crash if you're talking 30 to 60% crash of the market. Couldn't pin him down on when he thought it might happen. What's your view on that kind of extraordinary pullback of the stock market?
And in fact, here in Australia, growth is expected to be much stronger than other economies. So I think here in Australia, we're going to fare pretty well. I think where that sort of prediction comes from around a big crash is that usually when interest rates are changing around quite a lot, there can be policy errors by central banks. And I guess especially in the US, they're so behind the curve at the moment. The fear is that they will raise interest rates too quickly at a time when the US economy is slowing down. And given that we've been through the last couple of years with ultra low interest rates, virtually zero interest rates, as well as quantitative easing, there's not a lot of tools left for central banks to be using for an economy that is slowing down. But look, I think that's a bit too premature. At the moment, we haven't even seen one interest rate rise, although the market's pricing it in. And at the moment, it seems like, the US economy does need an interest rate hike. Inflation is hot, the jobs market is strong, the economy is growing well. So in that type of environment, you'd expect the central bank to move away from the emergency measures that were put into place during COVID.
Yeah, and I found it interesting that the NASDAQ went up pretty strongly, despite the fact that the jobs numbers said interest rates will probably rise quicker than expected. And ultimately, I think 2022 will become a battle between how strong is the US economy growing and how fast are those interest rate rises, and will they really be damaging to an economy that's looking pretty good?
Yeah, I think the great news for Australian investors is that, we watch the US stock markets, but we're also influenced by what's happening in China because it's a major export destination for our commodities. And if we have a look at China, China's moving away from the rest of the world, where in most Western economies, they're looking at interest rate hikes in 2022, whereas China has been already putting into place interest rate cuts. So I think the outlook for the Chinese economy to be stimulated and to grow a lot more strongly than forecast is looking bright. And that also bodes well for the Aussie share market, Australian investors, our economy, especially our miners. And certainly miners have been doing well in 2022 so far. And I think they'll continue to do well for the rest of the year.
Yeah, okay, let's go and talk about what you're buying now, because there's been a lot of sell-offs. There's a lot of stocks that look like really good value. I wrote courageously some of these tech and payment companies might look like good value now, but it might take a while before they actually materialise. But I did love the fact that Square went up 7% on Friday, and I figure the day Square really rebounds, other payment companies will benefit from it as well.
Yeah, it's been hugely volatile in the tech space as well as in the property space. And I guess these are two areas that are hit very hard by interest rate expectations. So I think these areas are going to continue to be volatile as long as the market's still pricing in what's going to happen over the next 12 months in terms of interest rates. And the expectation is moving around so much. So, it's not unusual for Square to move up 7% in a session, and it's not unusual for it to move down 7% in a session either. I guess with reporting season, Pete, I've been focusing more on, cycles and sectors that have been seeing a growth in earnings. And one area that I've been positive for a while is the agricultural space. And that's because, after a few years of bushfires, droughts, we've finally got rain, a good cropping season. Last week, New Farm was a standout. The stock was up 26% in a week. And then today we also had an upgrade coming through for New Farm was last week, and then today we had GrainCorp coming out with an upgrade. I'm very positive on the chemical side as well. So the fertilizer side, I've liked Incitec Pivot for a while. The pricing there is very strong. And Russia at the moment has banned exports of ammonium nitrate, which is used as a fertilizer for the next 2 months. And that should bode well for fertilizer companies. So we've also added Orica to the mix as well in that space. So I think the outlook for fertilizers is looking strong, not only because the agricultural space is doing extremely well, but on the pricing side, we've seen gas prices rising, and Australian companies have a bit of a benefit there. And also, of course, with that Russia ban as well, which usually sees a spike in pricing, but that effect is felt in terms of more medium-term, long-term contracts as well. So liking both Incitec Pivot as well as Orica in that space.
Yeah, you've become a bit of a country and western girl over the last year or so, and your tips have worked out for you.
I do love farms, cows, crops, canola crops, the bright yellow fields.
Race horses. Now listen, Julia, you talked about gas. Is there a company in that space that you like more than any other?
Look, I think all of the oil and gas companies, the major ones, are going to be doing well here in Australia, whether you're looking at Santos or whether you're looking at Woodside Petroleum. We hold Woodside Petroleum in the portfolio, but with the electricity prices, we've seen AGL Energy rising over the last couple of months. So one to also be looking at would be Origin Energy, which has the retail side of the assets, as well as the gas producing fields as well. So I think Origin's looking pretty interesting here, but, we've done really well through Woodside Petroleum over the last couple of months, and happy to hold an overweight position there, because I guess the thing with oil is that we haven't seen a lot of major investment coming into that space over the last couple of years, because it's not, very much in vogue in terms of the environmental aspect, the social aspect of things. And so I think we're still going to see very tight supply, which means that prices will remain relatively high this year.
And if you believe a global economy is going to be expanding, people will be driving, planes will be flying, all that sort of stuff means the demand's going up. And as you point out, the supply capacity hasn't increased much in recent times.
Absolutely. Please let there be some flying.
Yes, exactly right. Julie Lee, Burman Invest, thanks for joining us.
Thanks, Pete.
Well, I'm catching up with Jun Bei Liu of Tribeca Alpha Plus. And yes, we're in our new studio. Great to see you, Jun Bei Liu.
Great to see you, Peter, and it's very exciting to see each other in person.
It is, yeah. Even though this is not really a stock-related question, it's a relevant one because, I know you've picked out stocks that you think will benefit from reopening and getting back to normal. What are you seeing in the CBD now that you've got back to work as well?
Well, what we're seeing is that actually now the people are actually definitely visitation to shops and to restaurants are definitely picking up. We saw a momentary quietness just around the Christmas period where Omicron was hitting the economy and people were getting nervous around Christmas time. So January was very, very dead. So if you talk to all the retailers, things were very, very quiet in January. But we certainly have seen people coming back. And if you look at the public transport, it's actually looking pretty full now. I'm looking at our office. Our office is filling up, and most of the large businesses, however, have said that they will bring their workforce back by the end of this month. So that's all very good for the economy within, the CBD area.
Have you guys, tried to work out the severity of Omicron and when it might dissipate, because that's also an important indicator when the economy might start roaring back. Have you got any insights that might excite either me or my viewers?
Well, actually, it's all good news. Omicron, in terms of severity, is far less severe in terms of hospitalization as well as the symptoms and any of those. And that's been demonstrated globally. Look, it's more infectious, and we've seen how quickly the number built up. But the good news is we're already past that peak. In fact, we're past that peak weeks and weeks ago. So, if anything, it's actually good news now coming through. We're seeing Australian government today just talked about opening of the border for the tourists and things. That is very good news for our economy, to bring back jobs, bring back tourists, bring back tourist dollars. So, that is very good news. And I think around the world, most of other developed economy will be doing very similarly in the coming months.
All right, so we've also had a lot of excitement around inflation and interest rates. Were you happy that the Reserve Bank governor isn't sort of instantly falling in line with banking economists who thought that August will be the first interest rate rise? And they could still be right, but are you happy that he's not jumping at or fighting the bit to actually raise interest rates?
Yeah, look, I think absolutely. Well, look, I'm not surprised. I think he's doing the right thing because economists, in a way, they tend to assume everything goes up or goes down in a straight line. So, and quite often their predictions isn't exactly correct.
Now you're being nasty.
That's right. Look, I think because they change their view over time when the data comes into play. Right now, yes, the inflation is high, but not as high as the US.
Yeah.
In the US, inflation is incredible. They have to do something in the short term to bring that down. Whereas Australia, our inflation's there, but our job growth, employment number is looking strong, but we still, big part of the economy wasn't really open. So, we couldn't open the border. We don't have enough people to hire. So we have, all these inflated costs for the time being.
Yeah.
But in the next 6 months, when things reopen, certainly big part of that inflation will come through when it will actually start to dissipate. And this is what the governor is saying, that yes, we will increase rate, but at a slower pace.
Okay, that we seem pretty sensible. In America, they're really getting excited now. And after that job number on Friday, those who might have thought 4 or 5 rate rises in a year are now talking 7 or 8. What's your take on that? For me, there's two. One is, yes, the US economy is going gangbusters, or B, maybe that data wasn't reliable.
Of course it's not reliable, and we have seen so much noise during those short-term data trends. Overall, the data trend is showing it's getting stronger, and then the employment is getting better, and wage growth is coming through. So this is what they're a little bit worried about for the time being. Look, a market talking about interest rate increase of 7 times, that is just probably on the more extreme levels, because we still have to see how the economy is going to respond once you put up a couple of times. We've seen UK put up their rates twice, and New Zealand put up their rates a few times. Economy is still going okay. Then you'll start seeing increasing number of rate increase. But remember, at this point, it's still about bringing policy level back to normal level, because interest rate is still way below what it was before pandemic.
And I guess the point that none of us can work out, that if Omicron dissipates and a lot of these supply chain problems progressively get better, then the inflation that comes out of that will come off the boil, and that might reduce the need to raise interest rates so rapidly.
Absolutely. So this is when I say that economists tend to look everything in a straight line, because when that data point changes, most of them will probably expect the rate increase will get pushed down. Yeah. And no central bank, all the central banks around the world have been very committed not to burst not bubble, but not to burst the economic activity at this point of the cycle.
Okay, now I've written something for the Switzer report today where I call it a gutsy play. I'm not trying to say this is actually an absolute winner, but it seems to me that tech stocks and payments companies are really being clobbered. And I noted with great interest, like if there's a flag-bearing company for payments companies, it has to be Square in the US. Now, it's been clobbered, down 64% since last year. But I noticed last week it had a 7% rise in one day. Now, you can't use one day as a goal, but it seems to me, because payments companies like PayPal's been built up, Zip, Afterpay, all these have been built up. It seems to me sometime this year there could be a turnaround for both tech and payments company. Am I being too optimistic?
I think you're absolutely right. I don't think you're overly optimistic. First, in terms of turnaround tech, I actually think in general tech, they have been sold off a lot. And not just tech, it's growth companies that's been sold off a lot last month. Healthcare companies, Cochlear, CSL, ResMed, all of these businesses are trading at probably the cheapest has ever been with the structural growth layer. So these are the companies I think they have bottomed. They have already been derated, and it's a great buying opportunity actually enter now. In terms of payments business, because the reason being they've down so much is because they were more expensive than others. So they have been rebased. And also another reason being that payments business have been a big beneficiary of the COVID. So people doing a lot of online shopping, and then there's been a lot of transaction through. So far the expectations sort of, the companies are not really hitting the expectations. So sort of a little bit softer than what people were expecting. So the share price come off a little bit more than normal. But next 12 months, not only you'll find a buying opportunity in those companies, there will be a lot of M&A, especially in that buy now, pay later
I know
sector.
Zip's talking to Sezzle.
Sezzle, that's right.
Yeah.
And the share price still all-time low. If you look at Sezzle, it had a brief jump and then come back down. In fact, if anything, actually does look very interesting in that space. But be mindful that these are the companies don't make cash flow. So when the market going through big volatility, they tend to get sold off the first. But it absolutely represents an opportunity.
All right, now in this program, I've also interviewed Chris Joye, and Chris is saying that when interest rates rise, there could be a 30 to 60% correction there'll be a crash of the market. I did get him to agree that there's no guarantee it's going to happen this year or maybe even next year. What's your take when you hear and read things like that?
I wouldn't listen to a fixed income guy talk about equity markets. I think he's absolutely wrong. I think you've seen enough of the volatility. It's very easy for fixed income market to talk about, equity valuation so high and all of that. But look at the fixed income markets. A lot of real rates, a lot of bonds are trading at negative yield. That is for investor to give the bond issuer money to hold to buy their bond, which is ridiculous. So, all of these are trading at extreme valuation, and relative to fixed income, equity actually never look so cheap. It actually looks really, really cheap. And now with the valuation come off 10%, come off quite significantly actually for some of the really expensive.
Companies,
That's right, very expensive parts. And with the underlying earnings growth is still very strong. In Australia, if you take our resources company, next 12 months, we're looking at high teens growth. That's something like 17-18% growth for those businesses. At the same time, we're looking at dividend yield of close to 8-9%. That's a dividend yield. So that's a lot of return compared to what you get from fixed income. So equity looks really incredible.
My argument against Chris's was that in the short term, it's going to become a battle of how good is the economic growth and how fast do central banks raise interest rates. Now, if they don't raise interest rates too fast and growth is really, really good, I think the stock market can keep going up for 1 or 2 years. What do you reckon?
Oh, I think stock market is looking 1 or 2 years. I wouldn't put a time frame, but I think it looks incredibly strong for the next couple of years. And I think this is the time where you should look at some of the growth companies because very soon, right now we're going through a gyration. People go, okay, we have to reprice growth companies. But very soon the world and the investors will realize world is still going to lack growth after the economy reopens because cyclical companies will continue to struggle to find growth. And on a 5-year view, not many business can grow. So the growth company will still have a premium to the rest of the market. So it's time to actually look at some of those
Okay, so
leaders.
Before you go, give us your favourite 3 growth companies that you think look like great value now.
Absolutely. So Seek, I like. It's derated. It's going to have a good result. And then this employment market is incredibly strong. Xero is another one. It's not going to report this reporting season because it's out of cycle. But it's
a Kiwi company,
it's
really.
A Kiwi. That's right. It's global and the share price come off a lot. Another business is worth looking into this result is WiseTech. Again, it got derated. But look, last result was just incredibly strong. And we think it still have
And if
good
you
momentum.
believe that the global economy is going to be doing a lot of growth, a company in the logistics space you'd expect to do pretty well.
Absolutely. There's plenty of them. There's another one I want to sneak in, which is IEL. Hasn't been talked about for a little while. Share price come off a little bit, but that's education. Education, we've got the borders open now. Eventually students going to rush back. And don't forget, they're not just Australian market, it's a UK market, which the market is already open. And it's going to do very well on the longer term.
4 great growth stocks from Jun Bei Liu. Thanks very much.
Thank you very much.
That's Jun Bei Liu of Tribeca Alpha Plus. Well, joining me now is Chris Joye, and the subject today is Chris Joye catastrophizing our future, or are people simply misinterpreting him? Chris, thanks for joining us.
Hey, Peter.
All right. Now, a lot of people read you, Chris, of course, and some people, I think, do misinterpret you. But I want to get to the heart of the matter. There's a lot of controversial things going on. We saw the stock market sell off. It has rebounded. There's big calls out there on interest rates, and interest rates is your beat. You know a lot about interest rates. So let's start off there. What do you think is going to happen to the Fed this year and the number of interest rate rises you're expecting?
Yeah, mate, since last year, so since late last year, we have thought the Fed would raise 5, 6 or 7 times this year. The market was pricing 3, and we thought the market was complacent, and we thought the re-rating of expectations for rates, Peter, would trigger a 5 to 15% correction in stocks in the short term. And that's more or less what we've seen to begin this year. You know, they've pulled back. I think at one point, the S&P 500 was down north of 10%.
Yeah, that's right.
Yeah, the NASDAQ much worse. They've come back and then given back those gains somewhat overnight. So I think the first key point is you've got the highest wage growth, the highest core inflation, and the highest consumer inflation expectations since really the early 90s. And that demands a normalization of rates. So that's probably why we've been negative on both equities and also crypto. When we called out crypto in December, Bitcoin was at 52,000 US dollars. It's since traded down to 33K, but we've also been negative on our market on credit spreads.
Right. Okay. So that was what you called. I'm more interested in what you think is going to happen between now and, say, the end of the year. Now, I've been predicting volatility for a variety of reasons, not categorically because of the number of interest rate rises you're talking about. I just thought that the markets were certainly overpriced, particularly tech stocks. And I could see tech stocks were going to cop it as interest rates were going to rise. I didn't know how many they would rise by. But I still have the belief that our market will go up by at least 10% this year after a period of time where volatility prevails. So, Chris, tell me what you're expecting, first of all, for interest rates from here on in to the end of the year, and then what you think will be the implications for stocks.
Yeah, so I think the RBA will lift 2 to 3 times. We've thought since last year that the RBA would start raising rates late this year or early next year. And the brisk inflation data really does suggest, coupled with the employment data, that we'll see the first hikes this year. As I said, we're expecting 6 or 7 hikes from the Fed. We do think US equities probably need to adjust down by 30 to 60%. So if I look at a Shiller PE ratio, so this is a cyclically adjusted PE. Right now, the US equity market prices are trading at 37 times earnings. The only time we've seen that level of valuation was in 2000, just before the tech wreck. And then US equities fell 50%. Now, the average PE has been around 17 times, and the median's been 16 times. So we think stocks have really rallied about 30% above the pre-pandemic peak on the back of cheap money. And as that cheap money becomes much more expensive, we think asset prices will adjust down. So whether that happens this year or next, or the year after? That's an open question. What we saw last time the Fed hiked rates was they started in earnest in 2016, and stocks actually rose in 16, 17, and through part of 18.
Right.
So it's not inconceivable, the rally could continue, but my fear for equities is that the Fed's hawkish and they have an inflation crisis. All the alarm bells on almost every single economic measure are ringing loudly. Core inflation, wages, unemployment at 3.9%, for example, and core inflation's around 5, wages are around 5, consumer expectations are between 6 and 4 for 1 and 3 year future horizons. And this is a bit of a nightmare for the Fed and indeed for all central banks. And the other thing that's worrying is it doesn't appear to be global. This is a secular inflation increase, and it also seems to be driven by both supply and demand. So very tight labour markets are creating a lot of wage inflation, and that's feeding back into what looks like or at least the beginnings of a positive wage price spiral. So I do disagree strongly with the idea that equity should rally 10%, Peter. But I will emphasize here that I'm not sure about the time horizon. My sense is over the next couple of years, we'll start to see a very big correction. But I'm not certain. On house prices, I have a strong...
We hold house price for a minute, because it's a separate section, and it's an area where you have good expertise. My view has always been this, Chris, that the central banks have to be very careful about raising interest rates too quickly for the reasons you pointed out. The impact of a 30 or 60% correction in the stock market is not going to do anything for economic growth. And we all know the fiscal settings of governments around the world are such that they really need growth to pay for the kind of deficit spending they've been involved in. So I'm hoping where you get it wrong is that the Fed, though being hawkish, still might only do 3 or 4 interest rate rises this year, hoping that Omicron fades out and therefore the cost pressures in that inflation story you talked about start to dissipate. Now, if that happens, I'm a chance for being right, and your interest rate rises will more or less happen more in 2023 than 2022. And I've got to say, I've always been a bit worried about the stock market 2023 rolling into 2024. So I guess that's going to be the big watch. How aggressive is the Fed? If the Fed ends up being less aggressive than you think, then we should be less worried about a big stock sell-off. Is that a fair call?
Yeah, listen, I think your hypothesis was probably the Fed's view in December. It's perfectly reasonable, and it may come to pass. So you could well prove correct. I think the problem is, I fear that the Fed thinks the neutral or normal cash rate is 2.5%, and they're at 0.
Yeah.
And given 5% core inflation, 5% wages growth, and 3-point-something% unemployment, they shouldn't be at 2.5 right now. They should probably be at 3. So they want to get there as quick as they can. So I'm kind of with you, though, that I'm not convinced the normal cash rate is 2.5. I think because of the level of debt, it could be a fair bit lower. Here in Australia, the RBA says the neutral cash rate, amazingly, is 3.5 to 4%. Now, that would mean mortgage rates around 6. So from 2 currently. I think the real risk with the Fed is that the inflation is persistent, the wage pressures feed back into that inflation this year and next, and the Fed keeps on hiking until they do see a big correction in the equity market that may well stop them in their tracks.
Yeah.
The risk is that we get sustained inflation, and actually the only answer is a recession in the US.
Yeah.
And so another way of sort of saying what I'm saying is the Fed's trying to normalize rates, but they'd also say that they're trying to normalize the cost of debt and the cost of equity. So they actually have equities in their financial conditions index. And so for life to go back to normal, they actually need to see adjustments upwards in rates, and I think downwards in equities.
Yeah, I totally see it, but I just think, I hate saying this, Chris, because we've laughed at people in the past who've said this time it's different. But really, this time it is. You and I have never seen interest rates so low. The fact that you're actually even arguing that the normal cash rate may well be a lot lower than we historically would expect it to be, all it tells us that this time is different, and therefore using history as a guide may well not be as reliable as what might be needed with all the multiple objectives that the Fed must have. And one thing I know for sure, no central bank in the world and no government in the world really wants to contemplate a recession either in 2022 or 2023. They might live with it in 2024, but they don't want it over the next 2 years. Fair call?
Yeah, I think they definitely want to avoid a recession. And this is where the circularity you're talking about comes back. But I think that circularity is very important, or the so-called endogeneity. I think the reason this time is different is not because of the level of rates, although that's important. It's because we haven't seen inflation like this since the 80s or early 90s. And in the past, when stocks fell 30%, the Fed would cut and they'd do money printing and they'd buy everything. But they could only do that because there was no inflation problem. So that's what happened in 2018, or particularly in 2019. And they raised rates, equities fell, then they cut. And yeah, my fear is, mate, that freedom, that optionality to just pour money on all our problems is dissipating. And unfortunately, we may have to adjust to structurally higher rates. So, a cash rate north of 2% in the US, which I think will be a shock to the system. So I personally think, they'll move pretty quickly to 2.5, because that's where they got to in 2018. And Powell was governor or chair in 2018, and he oversaw those hikes. But I'm not sure neutral is 2.5. I think neutral could be, more like 1.5. But let's see. Ultimately, it's the empirical question. I think the difficult thing for investors is I don't think this Fed this time around will be as deterred by stock market turbulence and movements in bond and credit markets as it was in the past, because this time is different, because we obviously have this inflation shock to contend with.
Yeah. We also have very low levels of unemployment. Chris, let's go to housing. We haven't much time left, but you've got a view on housing. House prices, are they going to rise this year, fall in 2023, or are they going to rise for both years?
Yeah, buddy. So we've been, unfailingly or extremely consistent on house prices. So, we called the boom between mid-19 and March 2020. We called that very modest correction. We called the subsequent rebound in September 20, expecting 20% capital gains from September onwards. We then, a few months later, because mortgage rates fell further than they were at that point, we revised it up to 20 to 30% worth of capital gains post September 20. And we've certainly seen that. We've seen almost, I think 26% capital growth since September 20. And that's all been driven by purchasing power. It's been driven by cheap money. So late last year, we said, in October last year, so October 21, we said we thought prices would rise another 5 to 10%. Since that time, they've risen about 3.4%. But we did say, unfortunately, that after the first 100 basis points of mortgage rate increases, that and RBA cash rate increases, that national prices would pull back 15 to 25%. I don't think it'll be a disaster. I do think it'll be orderly. And it's just about the normalization of rates and therefore purchasing power. The RBA cash rate made in May 2019 was 1.5%. Today it's 0 or 0.1. So since May 2019, house prices nationally have risen 35%. And all we're saying is, as rates rise back to those levels, we think some, not all, of that price appreciation will be paid back. So I've been accused, just let me make one point. I've been accused of being a preternatural housing bull, in the March 2020 period when everyone said I was mad to think prices would only fall 0 to 5% and then rise by 20%. Obviously, that's what happened. And now people are kind of describing me as a perma bear, but really we're just trying to divine our destiny, and we're trying to bring our horsepower to bear on the problem of what will unfold. And that set of forecasts will obviously vary over time, mate.
Okay, it's a fair call, and primarily you've been accurate. You're even accurate on your calls on the spread of the coronavirus and when it would peak. So thanks for joining us, mate, and we'll catch up with you in the not too distant future.
Thanks, Peter. I really appreciate it.
Cheers, mate. That's Chris Joye from Coolbar Capital. My next guest is Paul Rickard of the Switzer report. I want to talk to him about Westpac and also ANZ as well, but also I want to get his reflections upon what Chris Joye is talking about, a 30 to 60% crash of the market. Paul, thanks for joining us.
Thanks, Peter.
Let's start with the banking story. What's your view on Westpac? I know you wanted to talk about that.
Yeah, look, Westpac reported a quarterly result last Thursday. Today we had ANZ. I think the characteristics of both results, Peter, are clearly there's net interest margin pressure. In other words, the margin between what they lend at versus what they borrow at is a lot of pressure occurring there. And that's going to continue. And a couple of factors driving that, first of all, has been the banks have all run up a lot of liquids, so a lot of sort of cash on deposit with the Reserve Bank, investing in very low yielding assets. But secondly, as we've seen in the home loan market, and in the business market, a lot of people borrowing fixed rate, and banks make a smaller spread on fixed rate mortgages than they do on variable rate mortgages. So that's what's driving it. I think the story about Westpac, though, Peter, coming back to your question, was that about 9 months ago, Westpac got up and told the world that they were going to cut their cost base to $8 billion. Now that was from a then current cost base of about $12.9 billion. So they were going to go almost a third, or a bit more than a third, over 4 financial years, which I think the market, no one really believed. Now, part of that came from selling businesses and, some of obviously a whole lot of costs going into remediation, because of the financial crimes and other problems they've dealt with. But even so, they still had to cut operating costs by something like 25% over 4 years. And so the positive in the first quarter figures that Westpac showed last Thursday was that they actually cut their costs by about $200 billion. Now, that's progress, but there's still a long way to go to get towards the $8 billion.
So the actual cut was $8 billion, did you say?
Well, it's taking it from almost effective $10.5 billion as you adjust for inflation to $8 billion. So it's about 25% in outright terms over 4 years. Yeah. And Westpac so far have managed about $200 million. Now that's a positive, and they say costs are going to come down further during this financial year. But that said, there aren't too many companies, Peter, that have cut their cutting costs has been a story to get to glory. And I think Westpac's it's probably one of the causes they need to follow. But they've also got to focus on revenue growth, and there's really precious little of that.
Are they a buy at these levels, Paul?
Well, I think the market, we saw about a 4% rebound on Westpac shares. I think they're sort of a bit in the middle of no man's land. Like, they're cheap. There's no doubt that Westpac is the cheapest bank. But you still can't, and while they're obviously going to make some headway in cutting costs, there's nothing that suggests that the company's really got the strategy or the leadership in place to actually think about growing its business. And I think the other thing that's a bit of an irony of Westpac is that they had this strategy of not so long ago, Peter, of sort of one kitchen, many dining rooms. So the whole idea is they owned these fantastic franchises called St George Bank, Bank of Melbourne, Bank of South Australia, and they've virtually disappeared in terms of there's no separate organisation, there is no separate sort of differentiated offering with their customers. They may as well almost get rid of the different brands. And you reflect on that and you think of the billions of dollars of value destroyed.
Yeah, because St George was a very good brand.
It was a very fantastic brand, incredibly nimble bank, market leader in many areas. And you wouldn't know it today because everything's just comes under the name of the big W. So they may as well get rid of the brands. The branches still exist, but for all intensive purposes, they're offering you exactly what you can get out of a traditional Westpac branch.
Was that a Freudian slip when you called Westpac Big W?
Well, they have a big W, Pete, don't they? I don't mean the retailer. But look, I mean, are they a buy? Coming back to your question, I think the NAB is still the best positioned bank because
CBA is the best bank, but too pricey.
CBA is the best bank. I think you sort of have. I don't say best and the worst, but to me, there's a bit of mean reversion, that is the banks sort of rotate amongst themselves. I like ANZ the least, that's why it's come down. Westpac has got hit hard because it reported so poorly last time. It's sort of recovering, but there's no, it's a brave person to really go 100% Westpac. I think the bank that's doing the most out there and is the most nimble and working the hardest is NAB. And that's the right be after the CBA looking.
Okay, let's get you to talk about, so Chris Joye, I've interviewed him on this program. Chris thinks that interest rates are going to rise quickly. He said 7 or 8 rises before those job numbers came out, so he got that right. But he thinks that the end result of interest rate rises and the fact that the stock market got ahead of itself is that he sees a 30 to 60% fall in the stock market. I then pressed him on when it might happen, and basically it could be this year, it could be 2023, or it could be 2024. What's your view on a big stock market?
I don't think we're going to see 30 to 60%. And as an ex-bond trader, I understand where Chris is coming from. But bond traders don't have a great track record with the stock market and vice versa. Bond guys are smarter, but the stock market's not always very smart, Pete.
Apologies to all my broker and fund managers out there, but still, go on.
Yeah, but look, I don't think we're going to see 30 to 60% because fundamentally, I still think that there's enough in the data to suggest that some of the inflationary pressures are transitory because of COVID-19. And I think we're forgetting, as I keep sort of saying to people, is that no one could quite explain why inflation became so low during the last couple of decades, right?
Yeah.
And
I think couldn't get it up.
They couldn't get it up. And I think what people forget about is that part of the reason was that we had this enormous disruption caused by new technology.
Correct.
And we still have that same disruption out there. The whole digitisation effect has meant that most companies can't raise prices.
That's right.
Because there's always somebody else coming along. There's a fintech if it's in finance or some other new startup that's going to eat their bacon if they're not careful.
Eat their bacon is the first time I heard that before. But
I'm mixing metaphors or something, right?
Right, it's a good one.
But it's a good one. It's an original one, I guess.
Yeah,
so that factor hasn't gone away.
Yeah.
And so sure, while we've got a lot of COVID pressures, we've got supply chain disruptions, we know commodity prices are high, there's reasons why inflation's up. I'm still on the camp that this is going to be transitory.
Yeah.
The Federal Reserve will raise interest rates. I'm not sure it's going to be 7 times. I don't think they want to kill the place.
No.
We're going to see some sort of orderly rise in interest rates. And as you point out in the data you've published in the Switzer report, the data actually says that interest rates going up statistically is not bad for stock markets.
Correct.
Right?
Yeah.
So, look, I can see why people are getting concerned, and good bears come out of the hibernation, which they do, as soon as they get the first sniff.
Yes.
But,
After losing for a long time.
Yeah, we're still in a correction, right?
Yeah.
The long-term trend is not been broken, and anybody who's saying 30 to 60%, look, and I appreciate Chris is doing it for the right reason, but it's really a little bit headline seeking, I think.
Yeah, and the bottom line is, one day there will be a crash. It always is. And I've got to say to our financial planning clients, I said that 2022, I'm confident. 2023, I'll be less confident. And 2024, I could be a little bit scared. But I still think there's probably 1 to 2 good years for the stock market left. Paul, thanks for joining us.
Thanks, Peter.
It's Paul Rickard of the Switzer Report. And that's the show for tonight. Don't forget, what we look at here are sort of short views on very interesting stocks. The Switzer Report gives you in-depth analysis by a whole range of experts who spend a lot of time looking for the best value stocks out there, and sometimes I'll tell you it's time to get rid of stocks as well. So think about subscribing to the Switzer Report. Go to switzerreport.com.au. Once again, thanks for joining us. I'll see you on Thursday night.